problem 8, exercise 115 in the text, gives you some information, and it asks you, and it requires you, it asks you to produce an income statement by the contribution margin format and the traditional format. Here's the information that it gives you. And remember, when you're doing a traditional format, you group expenses by function. When you're doing a contribution margin format, you group expenses by their behavior. So we're going to do the contribution margin first. Or I'm sorry, we'll do the traditional one first. That's the one you're most familiar with. So we have sales, $150,000, just like we did in accounting 1. And they're giving us these numbers. And then the cost of goods sold, we have to do a little computation. They tell us our beginning inventory was 30. Okay, so we have beginning inventory of 30 plus purchases of 100 minus ending inventory of 40, and that gives us cost of goods sold of $90,000, just like we did in accounting 1. So our cost of goods sold, beginning inventory plus purchases minus ending inventory, $90,000. Our gross margin is $60,000. You did several dozen of these in 2101. Now we have some selling and administrative expenses. And we have $50 per unit, 200 pairs. That's our variable cost. Okay, variable selling cost per unit, $50, and our fixed of $20,000. So we have 50 times the 200 pairs plus the 20,000. So that's 50 times 200 is 10,000 plus 20 is 30,000. So that's our selling expense. And then we have our administrative expense. And again, that's $10 per unit times 200. That's 2,000 plus 20,000 fixed. And again, that information is given to us. So that's 22,000. So our total selling and general admin is 52,000, and our net operating income before tax is $8,000. Nothing there that you haven't done at least 2 dozen times in 2101. Now we're going to do the same information in the contribution margin format, where we look at the expenses not as how they function, but how they behave. So we're going to look at our sales. Our sales stay the same. That doesn't change, 150,000. But our cost of goods sold here is our variable cost, and that's still 90,000 because for every pair of skis we sell, we have variable cost. So our cost of goods sold, our variable cost of goods sold, is still 90,000. That doesn't change. Remember, this is a retailer, not a manufacturer, so we don't have work in process and things like that. Then we have selling expenses per unit, variable selling expenses per unit. Okay, remember, we got selling price per, that's a variable cost. Selling expense per pair, variable. Admin per pair, variable. So we're going to put all the variable costs together. We have 10,000 and 2,000. So that's 102,000. And our contribution margin is sales minus variable expenses. It's $48,000. Now we have fixed selling expenses of $20,000. Again, from the information they give us, fixed selling and fixed admin, $20,000 and $20,000. So our fixed admin expenses are $40,000, and our operating income is $8,000. Notice that's exactly the same number we got under the traditional format. But the contribution margin format gives us more information for decision making. And the last thing it asks us is that since we sold 200 pairs of skis and the contribution margin was $48,000, what was the contribution margin per unit? So for that, we'll take the $48,000, the total contribution margin. We had to sell 200 pairs of skis to get that. Therefore, the contribution margin per pair is $240. Contribution margin income statement takes the fixed cost out, focuses your attention on the variable costs, because the variable costs are costs that you can manage. They're costs that are significant to management. They give you ways to look at your business and think about your business. You come up with the same number. You just get there by taking two different paths.